Two of the biggest oil giants in the world, Exxon and Chevron, are longtime favorites among dividend growth investors. But which is the better buy for 2025? I'm Nick and this is the Dividend Growth Income channel, and in today's video we're going to compare these two energy monoliths, looking at their dividends, growth rates, financial strength, and future prospects to see which one deserves a spot in your dividend growth portfolio. Now, before we get into it, this video is for educational and entertainment purposes only. It reflects my personal investing journey and should not be taken as financial advice. Investing involves risk, including possible loss of principal, so always do your own research or consult a licensed financial advisor before making any decisions. This channel always aims to remain within YouTube's terms and guidelines at all times, and I want to be clear that dividend investing is not a get-rich-quick scheme, and there are never any guarantees. And one more quick note, YouTube recently removed my 3-year dividend portfolio update for quote-unquote harmful and dangerous content, lumping it in with get-rich-quick schemes, which is the exact opposite of the spirit of this channel. I appealed and it was rejected, and I'm now waiting on a human manual review. So if you could drop a comment to let YouTube, whether this is human or AI, know that we are about slow and steady and transparent dividend investing, it would really mean a lot. My channel is not doing the best right now. Thank you so much for your support. Chevron has a market cap of about $317 billion, while Exxon is the significantly larger firm at $481 billion. Both companies are direct descendants of John D. Rockefeller's Standard Oil and remain two of the largest integrated energy companies in the world, exploring, producing, refining, and selling oil and gas across the globe. Even at moderate oil prices, each company generates billions in free cash flow, giving them the financial firepower to fund dividends, buybacks, and new projects. And pay dividends these companies absolutely do. ExxonMobil has been paying uninterrupted dividends for 143 years, while Chevron has been doing it for 113 years. This is absolutely incredible track record, more than a century of paying out cash to shareholders through world wars, recessions, oil crashes, and everything else history has thrown at them. On the dividend growth front, Exxon holds a slight edge with 42 consecutive years of dividend raises, while Chevron is right behind with 37 straight years, both firmly in dividend aristocrat territory. But here's where it gets interesting, because while Exxon does have that slightly longer track record, Chevron has been the stronger dividend growth stock in recent years. Over the last 10 years, Chevron's dividend grew at an average annual rate of 4.5%, and over the past 5 years, that number jumps to an impressive 6.5%. In January, Chevron announced its 37th annual dividend increase, a solid 5% raise, all while paying a starting yield north of 4%. Exxon's growth has been a bit more modest, with a 10-year CAGR of 3.6% and a 5-year CAGR of 2.3%. That said, their most recent raise last November was a step up at 4%, which could signal a return to stronger dividend growth going forward. Let's hope. ExxonMobil, ticker XOM, pays its dividend quarterly in March, June, September, and December, with a current payout of 99 cents per share, and that's $3.96 annually. The next ex-dividend date is probably going to be around November 14th, and we should also see the next raise announced around that time, with a payout likely hitting accounts around December 10th. At today's share price, that works out to a forward yield of 3.51%, slightly below Exxon's 5-year average yield of 3.66%. Not a dramatic drop, but it usually means the stock is fairly valued, or maybe slightly overvalued by dividend yield theory. For a premium stock like Exxon, I would say it's more a reasonable value. Chevron, ticker CVX, also pays in March, June, September, and December, with a much larger payout, $1.71 per share quarterly, $6.84 annually. This gives Chevron investors a forward yield of 4.38%, meaning you can get more income today compared to Exxon, and better dividend growth historically. The next ex-dividend is estimated for November 18th, with the payout likely hitting around December 10th. And importantly, that 3.89% yield is right in line with Chevron's 5-year average yield, suggests the stock price is close to fair value, much like Exxon, but perhaps slightly more attractive by dividend yield theory standards than Exxon. Now let's look at the dividend safety, because payout amounts, yields, and historical growth are meaningless without understanding whether they can continue paying these dividends and growing the dividend going forward. According to simplysafedividends.com, Both companies score very well. Exxon currently has a safe score of 80, reaffirmed as of August 15th, 2025. However, Chevron scores even higher with a very safe rating score of 90, reaffirmed on that same date. So a slight edge here to Chevron. Both companies also share a very strong AA- credit rating, which puts them among the most financially secure companies in the energy sector. Looking at payout ratios, ExxonMobil is paying about 56% of forward earnings and 56% of forward free cash flow. For oil producers, that is a bit elevated. We ideally want to see these values under 40%, but it's not out of line nor a red flag. Chevron is a bit more aggressive with their payout ratios at 79% of forward earnings and 54% of forward free cash flow. So again, on the high side, but we're still considering these safe dividends, giving their consistent cash generation. So while Chevron's payout is a little higher, both companies have an ample ability to sustain and likely continue raising these dividends even in a moderate oil price environment. Both companies also look very solid when it comes to leverage, which is critical for long-term dividend safety. ExxonMobil has a net debt to EBITDA of just 0.38 and a net debt to capital ratio of only 9%. They have done an excellent job reducing leverage over the last 5 years since the pandemic, and that should help investors sleep well at night. Chevron's debt levels are also comfortably within an acceptable range. They've steadily reduced debt as well, now sit at a net debt to EBITDA of 0.56 and a net debt to capital of 15%. So while Exxon does get the slight edge here when it comes to leverage, both companies have very strong balance sheets. I think investors should feel fine holding either one if they're concerned about debt risk. Now, neither of these companies is exactly a screaming buy right now. ExxonMobil is trading at a forward PE of 15.9 compared to its 5-year average of 12.3. Chevron is even more expensive at the moment with a forward PE ratio of 18 compared to the 5-year average of just 12.2. So right now, you're paying a premium owning either of these companies, and that matters if you're trying to get the best possible starting yield and lock in a favorable cost basis. So my take on these are to be opportunistic, keep both companies on your watch list, and just wait for one of those inevitable pullbacks. Because in the energy sector, there's always some short-term drama that'll drive prices down. Very cyclical energy. So patience can pay off. Buying these stocks only when they're reasonable or below is kind of how I would handle this myself. That said, if you're just looking to own long-term, collect dividends, sleep well at night, dollar cost averaging into either company, I think is a perfectly fine strategy. Let's look forward. What's on tap for Exxon and Chevron? And what is the better runway from here? For ExxonMobil in the first half of 2025, they generated about $24.5 billion in cash flow from operations and $14.2 billion in free cash flow. They're sticking with their capital expenditure guidance of $27 to $29 billion for 2025. Also, there are 10 advantaged projects in progress this year. 6 already started, 4 coming, which management expects will add over $3 billion of earnings in 2026 at consistent prices and margins. On the downside, Exxon flagged a potential negative $1.5 billion impact in earnings due to oil and gas price weakness, so sensitivity to commodity moves remains high. Chevron, on the other hand, is continuing to generate strong cash with recent guidance pointing towards an expected increase in free cash flow of $6 to $8 billion in the coming year, driven by new or expanded production in the U.S. shale, the Gulf of Mexico, or America, whatever we're calling it now, and projects in places like Kazakhstan. Their $53 billion acquisition of Hess is now closed, which strengthens their exposure in Guyana's Stabroek block. I hope I'm saying that right. That is going to be a big growth lever for Chevron. The company's also delivering on returns to shareholders. Their buybacks, that remains a priority as well, even as it trims costs slightly. So what this means for dividend growth investors is that right now, neither company has a crystal clear massive discount right now. Both are trading with some premium built in, but there are growth catalysts that could make both interesting holds. Exxon looks like the more defensive pick in volatile times. If you want higher yield, stronger near-term growth drivers, Chevron offers a little bit more upside, but with more sensitivity to oil price swings. In short, I think both are solid, and which one's better for you just kind of depends on your own situation and investing needs. Year to date, Chevron shares are up over 7.5%, while Exxon shares are up a little less than 5%. So Exxon has been the underperformer so far this year. And look, that could mean a lot of things. Maybe the momentum is with Chevron and that will continue. Or maybe Exxon is just waiting for its breakout. You'll have to make that call for yourself. One useful metric I like to look at is 10-year total return. This includes dividends reinvested. And if you've held Exxon for the last 10 years, you'd be sitting on about 138% gain on your initial investment. That's not too shabby. But if you held Chevron, you'd be doing even better. It's about a 208% total return. That is impressive, but still short of the S&P 500, which returned 308% over the same stretch. So does this mean that we shouldn't even invest in oil stocks? I don't think so. Remember, the goal for most investors who hold names like Chevron or Exxon is that they want the dividends and dividend growth, and you're not necessarily getting much of that with an S&P 500 index fund. On the other hand, if you're a younger investor with a lot of time on your side, you probably want to lean more on those sort of growth-oriented vehicles like an S&P 500 index fund. Now, while Chevron has clearly been the winner versus Exxon over the last decade, that's not going to say that trend is necessarily going to continue over the next decade. It's entirely possible both of these companies outperform even the S&P from here. As for me, I am in Team Chevron right now. It currently makes up about 6% of my dividend growth income portfolio, which I do share on this channel, always within YouTube's terms and guidelines and rules. I always play by the rules at all times. And if you want to see how the portfolio is doing 3 years into the dividend investing journey for it, well, hopefully YouTube has corrected the issue and you can see it now, or I'll have to put something else together and just be extra sure it falls within those very important YouTube guidelines. So thank you so much for watching, and until next time, my friends, keep investing.